What's up, everybody? It's the Fit Wallet. And today we're talking about one of the most important things you can do as a young adult, building your credit score. Think of your credit score as your financial GPA. It determines your access to loans, apartments, and even job opportunities. The tricky part, you need credit to build credit. So, how do you start from zero? I'll break down the top 5 credit builder accounts for beginners: Kikoff, Self, Chime, Credit Strong, and Grow Credit. For each, I'll cover how it works, what it costs, and the real pros and cons. The sooner you start, the better. Credit history length is a big deal. A few years of positive payments now can save you thousands in interest later. Ready to take control of your financial future? Let's get into it. Let's dive right in. First up is Kikoff, known for its super low barrier to entry. It's designed to be accessible to almost anyone, regardless of their current credit situation. Kikoff gives you a $750 revolving line of credit, a substantial amount that can really help boost your credit utilization ratio. But you can only use it in their online store for digital goods like ebooks and online courses. Think of it as a curated marketplace designed to help you build credit. You make a small purchase, pay it back consistently, and Kikoff reports your on-time payments to Equifax, which is a major credit bureau, and Experian, another key player in the credit reporting world. The cost? Just $5 a month. A very affordable price point for those just starting out. The pros, and there are several: no credit check required to get started, minimal cost, and almost no risk of overspending since you're limited to their online store. It's a set-it-and-forget-it system. Perfect for those who want a hands-off approach to credit building. Great for absolute beginners. It simplifies the often complex world of credit. But there are cons. As with any credit building tool, Kikoff usually only reports to 2 bureaus, Equifax and Experian, not all 3. If a lender checks TransUnion, your Kikoff history won't show up, potentially impacting your approval odds. Also, you can't use the credit line for real-world expenses, limiting its flexibility, so you're not learning to manage a traditional credit card with everyday purchases. The impact on your credit utilization is limited, as the purchases are typically small, and some lenders may not weigh Kikoff as heavily as a major bank card when making lending decisions. Kikoff does offer other products, expanding their services beyond just the credit account, but their main credit account is the starter tool, the foundation upon which you can build. It's perfect for someone with zero credit, a blank slate ready to be written on. Who wants a safe, easy way to start building payment history and establish a positive credit track record? Just remember, and this is crucial, it's a stepping stone, not a complete solution to all your credit needs. You'll likely need to add other credit products later to truly round out your credit profile, to build a strong profile that lenders will view favorably. Think of Kikoff as level 1 in your credit building journey, the starting point of a longer quest. It's not a magic bullet that will instantly solve all your credit woes, but it's a solid first step in the right direction. If you're intimidated by traditional credit cards and the potential for debt, Kikoff is a low-risk way to get started and dip your toes into the world of credit. But don't expect it to do all the heavy lifting for your credit score. It's just one piece of the puzzle. Use it to get your foot in the door and establish a credit presence, then move on to more robust tools, like secured credit cards or credit builder loans, as you grow and gain confidence. For the right person, someone just starting out, it's a simple, effective way to start building credit. Just know its limits and plan to diversify your credit building strategy for long-term success. Ready for the next level and a more comprehensive approach? Let's check out Self. Next up, we have Self, a platform that operates on a slightly different model compared to Kikoff. It's important to understand these differences to choose the best option for your financial goals. Self specializes in offering what they call a credit builder account. This account functions as a small loan that you gradually pay off over a set period. This consistent repayment activity is what helps build your credit profile. A key distinction is that you don't receive the loan amount up front in a lump sum. Unlike a traditional loan, the funds aren't immediately accessible to you. Instead, your payments are directed into a secured, locked savings account, specifically a certificate of deposit or CD. This CD acts as collateral for the credit builder loan. A significant advantage is that each on-time payment you make towards your credit builder account is diligently reported to all 3 major credit bureaus: TransUnion, Equifax, and Experian. Once you've reached the end of the loan term, you'll receive your accumulated savings back. However, it's important to note that this amount will be minus any interest accrued and a small fee charged by Self for managing the account. The pros are clear. Self-reports your payment activity to all three major credit bureaus, which significantly helps you build a positive payment history. Plus, it encourages and almost forces you to save money. This makes Self a particularly attractive option for individuals who are looking to simultaneously build their credit score and cultivate a savings habit. It's a two-in-one financial tool. However, there are downsides. Self isn't a completely free service. You'll encounter a one-time administrative fee and accrue interest on the loan. Consequently, the amount you receive back at the end of the term will be less than the total amount you paid in over the life of the credit builder account. Essentially, you're paying for the credit building service that Self provides, rather than expecting to generate a profit or earn interest on your savings. It's also important to recognize that a credit builder account is a financial commitment. If you miss payments, your credit score could be negatively impacted, potentially undoing the progress you've made. Therefore, before signing up for a Self credit builder account, carefully assess your budget and ensure that you can comfortably afford the required monthly payments. A significant advantage of using Self is that, after establishing a positive payment history with your credit builder account, you may become eligible to apply for the Self Visa Secured Credit Card. This secured card allows you to use the funds accumulated in your savings account as the security deposit, making it easier to get approved. Obtaining a secured credit card through Self can further enhance your credit profile by adding a second type of credit to your credit report, which can positively impact your credit mix. Self is ideally suited for individuals with a reliable and steady source of income who are committed to both building their credit worthiness and establishing a consistent savings pattern. The primary benefits of Self include reporting to all three major credit bureaus, the built-in mechanism for forced savings, and the potential opportunity to transition to a secured credit card. The main downsides to consider are the associated costs, including fees and interest, and the commitment required to make consistent, on-time payments. Compared to Kikoff, Self represents a more significant financial commitment, but it also offers a potentially more substantial impact on your credit score and savings. If you feel prepared to take a more significant step towards building credit and savings, then Self could be a very strong and effective choice for you. Just ensure that you fully understand the terms and conditions, and that you're genuinely ready to take on the responsibility of managing a credit builder account. When used responsibly and consistently, Self has the potential to be one of the most effective credit building tools available on the market today. Now let's shift our focus and take a look at a card that functions similarly to a debit card in its everyday use, but simultaneously works to build your credit history: Chime. Third is the Chime Credit Builder Secured Visa Credit Card, a unique option that's exploded in popularity. To get it, you need a Chime checking account and a qualifying direct deposit. Here's how it works. You move money from your Chime account to your credit builder account, and that amount becomes your credit limit. You can only spend what you've preloaded, so it feels like a debit card. At the end of the month, Chime automatically pays off your balance with your own money. Chime reports your on-time payments to all three bureaus. The pros: no credit check, no annual fees, no interest, and no risk of debt. It's free to use if you're already banking with Chime. It also sidesteps the credit utilization trap. Chime reports your payment, not your utilization. The cons: you have to use Chime as your bank and set up direct deposit. If you're happy with your current bank, this might not be for you. Also, Chime doesn't offer an unsecured card to graduate to. You'll need to apply elsewhere when you're ready. Chime is perfect for anyone who wants a safe, modern way to build credit without the risk of overspending. It's especially good for those nervous about traditional credit cards. If you can meet the requirements, it's one of the most user-friendly credit-building tools out there. It's a great way to build a solid foundation with all three bureaus. If you want a free, foolproof way to start, Chime is hard to beat, but if you want more flexibility or rewards, you'll eventually need to move on. Next, let's talk about a heavy-duty option: Credit Strong. Credit Strong is similar to Self, but it operates on a larger scale, offering bigger numbers and longer repayment terms. It's designed for those who need a more substantial boost to their credit profile. They offer large credit builder loans, sometimes up to $10,000, which can be a significant advantage for individuals looking to establish a solid credit history. This substantial loan amount can make a noticeable difference in your credit worthiness. With terms as long as 10 years, this extended repayment period allows for smaller, more manageable monthly payments, making it easier to stay on track. You make consistent monthly payments, which are diligently reported to all three major credit bureaus: Experian, Equifax, and TransUnion. and the principal amount of your loan is securely locked in a savings account until the loan term comes to an end. This ensures that the funds are available to repay the loan, providing security for both you and the lender. The big pro, a large installment loan, can add serious weight to your credit profile, demonstrating your ability to manage debt responsibly. It's particularly beneficial for someone with a thin credit file, who wants to impress lenders and build credibility before making a significant purchase, such as a mortgage or a car loan. Plans are flexible, offering a range of different loan amounts and repayment terms to suit your individual financial situation and goals. At the end of the loan term, you get your original principal back, minus any accrued interest and associated fees. But the cons are significant. High interest rates and a long-term commitment are important factors to consider before signing up. Over the course of 10 years, you could end up paying hundreds or even thousands of dollars in interest, depending on the loan amount and interest rate. If you encounter financial difficulties and can't make your payments, you risk defaulting on the loan, which can severely damage your credit score and negatively impact your financial future. You have the option to cancel the loan early and get your principal back, but keep in mind that certain fees will be deducted from the refunded amount. Furthermore, closing the account early can slightly lower your credit score, as it disrupts the established payment history. Credit Strong is best suited for individuals with a stable and predictable income stream, who are committed to a long-term credit-building strategy. It's definitely not recommended for anyone living paycheck to paycheck, or seeking a quick fix to their credit problems. This requires patience and financial discipline. Think of it as the heavy lifting equipment in the credit gym. It's designed for serious credit builders. Powerful, but definitely not for beginners who are just starting their credit journey. If you're ready for a serious financial commitment and want to add major weight to your credit profile, demonstrating your ability to handle a significant loan, Credit Strong is certainly worth considering as a tool to achieve your credit goals, but it's crucial to respect the inherent risks involved and make absolutely sure you fully understand the total cost of the loan, including all interest and fees. For most people who are just starting out, a simpler and more beginner-friendly tool like Chime or Self is likely a better starting point to build credit. But for the right user, someone who is financially stable and committed to the long term, Credit Strong can truly be a game changer. Now let's shift our focus and look at a clever, low-effort option for building credit. Grow Credit. Last up is Grow Credit, which lets you build credit using your existing subscriptions. Think Netflix, Spotify, or your cell phone bill. Grow Credit gives you a virtual MasterCard with a small limit, usually $17 to $50 per month. You switch your subscription payments to this card, Grow Credit pays the bill, and you pay Grow Credit back. They report your on-time payments to all three bureaus. The big advantage, you're building credit with money you're already spending, no extra cost on the free plan. It's seamless and easy for anyone with at least one subscription. There are paid plans with higher limits and more options, but the free plan is a great way to start. The main con, the credit limit is tiny, so the impact on your score is gradual. If you don't have subscriptions, Grow Credit isn't useful. Paid plans add a monthly fee, so weigh the value before upgrading. It's a niche product, but perfect for young adults or credit beginners who want a no-cost, low-effort entry point. Grow Credit is a clever financial hack. Use it alongside other tools for a well-rounded credit-building plan. It's not a complete solution, but it's a smart supplement. If you're already paying for Netflix or Spotify, why not get credit for it? Combine Grow Credit with something like Chime or Self for best results. It's simple, effective, and free to start. For the modern consumer, it's a no-brainer add-on. Ready to put it all together? Let's wrap up. That's a wrap on the 5 best credit builder accounts for beginners. Quick recap. Kikoff is a low-risk starter. Self builds credit and savings. Chime is a free, safe debit-style card. Credit Strong is for serious long-term builders. And Grow Credit turns your subscriptions into credit history. There's no single best option, just the best fit for your goals and habits. Do your research, read the fine print, and choose wisely. Building credit is a marathon, not a sprint. Thanks for watching. If you found this helpful, hit like and subscribe for more money tips. Drop a comment with your questions or which tool you're considering. See you in the next video.